Life can be unpredictable, and temporary financial crunches can arise for various reasons, such as home renovations, family weddings, or medical emergencies. In these situations, your first instinct might be to dip into your savings or liquidate investments, often causing a loss. If that still doesn't suffice, you might consider taking out a loan. However, selling your investments prematurely is not the best course of action. Instead, you can use your mutual fund holdings to secure a loan. Much like pledging gold or real estate, banks and non-banking financial companies offer loans against mutual fund units. Here are 6 key insights about taking loans against mutual funds. The loan amount you can secure depends on the mutual fund type and the lending institution's policies. For example, banks like HDFC and ICICI offer loans of up to 50% of the net asset value for equity mutual funds and up to 80% for debt mutual funds. Meanwhile, Axis Bank provides up to 85% for debt funds and 60% for equity funds. These percentages highlight that different institutions and fund types yield varying borrowing limits. Banks tend to have a predefined list of eligible mutual funds. For instance, SBI offers loans against schemes from SBI mutual funds only. Similarly, HDFC and ICICI grant loans against schemes managed by AMCs registered with CAMS. Axis Bank also has a specific list of eligible schemes which is available on its website. One significant advantage is the lower interest rate compared to personal or credit card loans. Loans against mutual funds are secured as the funds act as a collateral. Interest rates typically range between 8 to 10%, varying by the lender and fund type. Loans against debt funds usually have lower rates compared to equity funds. In contrast, unsecured personal or credit card loans attract higher rates due to the absence of collateral, often exceeding 10%. Even when you pledge your mutual fund units for a loan, they still remain invested in the market. The bank has the right to sell the units only if you default on repayment. As long as you meet your obligations, your investments continue to grow, ensuring your financial plan stays on track. This allows you to secure immediately liquidity without losing any potential returns. Modern banking technology enables you to apply for loan against mutual funds online. A lot of banks allow you to pledge your units digitally and set up an overdraft limit in your account. Now, this facility lets you withdraw more money than your account balance up to a pre-approved limit with interest charged on the utilized amount. The latest financial data highlights a significant increase in the use of personal loans against shares and mutual funds. As of August 2024, the outstanding loans in this category stood at Rs 9,722 crore, reflecting a year-on-year growth of 27%. Now, this surge coincided with the broader personal loan segment, which grew by 14% during the same period. The rise in such loans is partly attributed to a strong market performance in recent years. However, this trend is being questioned as the market has corrected by 10%, marking the end of a prolonged bull run. Financial institutions typically allow borrowing of up to 50% of the NAV of your equity mutual funds and up to 80% of the surrender value of your debt mutual funds. These loans are structured as overdraft facilities with interest charged only on the utilized amount. Opinions on this practice are divided. On one hand, borrowing against securities offers advantages such as lower borrowing costs compared to traditional personal loans. This option can be helpful in urgent situations like medical emergencies or educational needs, as it provides quick liquidity without the immediate need to sell investments. However, critics caution against the risks associated with this trend. The volatile nature of the markets means the value of a pledged securities can fluctuate, potentially requiring borrowers to provide additional collateral or risk liquidation of their investments if they default. Furthermore, experts advise against over-leveraging portfolios. Borrowing more than 20 to 25% of the portfolio's value is considered risky, as financial institutions typically offer loans covering only 40 to 50% of the portfolio's worth. Now, loans against mutual funds aren't your only option in emergency situations. This is why people approach this by building an emergency fund so that you can be prepared in situations where you don't have to take out a loan. Now, an emergency fund should ideally cover 6 to 9 months of all your living expenses with an additional buffer of 25%. Now, this ensures that unexpected expenses can be managed without resorting to borrowing or liquidating your investments. While loans against securities are preferable to high interest rate options like credit card debt, they still carry costs. Borrowers must weigh the benefits of quick liquidity against the potential risk of losing their investments. StackWealth offers a seamless loan against mutual fund solution with the Mirai Asset Financial Services designed to provide instant liquidity without requiring you to sell your investments. With an interest rate of just 10.5% per annum, you can manage unexpected expenses through a fully digital process that ensures quick access to funds within 15 minutes. The service operates as an overdraft facility, allowing you to withdraw and repay funds as needed with interest charged only on the utilized amount. StackWealth supports a wide range of approved mutual funds, enabling you to mark your investments while retaining ownership and enjoying long-term growth. With zero foreclosure charges and no physical documentation required, StackWealth's loan against mutual fund service is a hassle-free option to unlock the value of your mutual fund portfolio without compromising your financial goals. In conclusion, loans against mutual funds can be a more cost-effective option compared to personal loans or credit card debt, thanks to their lower interest rate. However, they are still generally costlier than loans against assets like gold or fixed deposit. Before deciding, evaluate all your options to ensure you choose the most suitable option for your financial needs. Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high-performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign-up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert-curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.